All righty. What's going on, everyone? We've got a very fun video planned for today. I'm joined by Mike here. We're going to be talking mainly about the book, A Random Walk Down Wall Street, and all of the investing gems that come with it. There it is on the screen. And we'll see where the conversation goes. We got a lot to talk about. How are you doing today, Mike?
Doing very well, very well. Excited that we're finally making this happen.
Yeah, this was a long time coming. So, special video for you guys today. And to start it off, I wanted to ask you a question, Mike. I think that it can tell you a lot about the type of investor that you are. And the question is, what type of monopoly player are you? What is your go-to strategy? And I know personally, I've always been all about the railroads. Every time someone rolls the dice, you have a chance of getting paid, and it's a good income stream. And when I was younger, I was definitely more interested in the Boardwalk Park Place area because somebody lands on there, you hit the jackpot. But over time, I think I've kind of shifted to more of a slow and steady, approach, which I think kind of shows I'm getting a little more conservative as I get older. But what's your strategy with Monopoly?
Land grab, 100%. If you land on it, you grab it. So that's the idea. And then as the game progresses, you have the choices of which monopolies you want to go after that you can usually trade for. But if you're trying to target a specific property, you may never land on it. And even if you do end up getting it, there's no guarantee that anyone else is going to land on it. And so, like you said, everybody goes after the boardwalks in the park place, but statistically speaking, it's a lower likelihood that people land on it than the Marvin Gardens, for instance. So you probably didn't expect me to have all of the properties memorized, but here we are. So.
I kind of had a feeling. That's funny. Yeah. Yeah. So you're just scorched earth. Yeah. I mean, every property you get, I guess you start building some income stream. So makes sense. But yeah, I pulled that little nugget from the book and I was thinking about it. I was like, that's actually really interesting. And I feel like, like I'm all about establishing the income streams, and I feel like the railroads kind of like a dividend stock, so thought that would be a fun way to start off here. But yeah, Random Walk Down Wall Street. This book, I had read it a few years ago, got the chance to reread it recently while we were going through it. And yeah, I guess what are your high level takeaways? What'd you think of it?
I love this book. So I got started in the industry, full service financial services, and I'd read those basic entry level Millionaire Next Door, or what is it, the Rich Dad Poor Dad. These are the books that just kind of float out there. You got to read them and sort of write a passage, and they'll do some favors for you. But Random Walk Down Wall Street was the first book that I read when I entered the financial services industry. And I just think if you have any interest in investments whatsoever, you have to read this book. There are a few others out there that are going to be slightly easier reads, but if you want to have any sense of what you're doing with your money and how it's getting invested, this is the one book that I would recommend above any other. But what about you? I mean, how do you feel? I know you've read it before, and we both kind of read it again to refresh on the landscape of resources out there. Where do you place this one?
Yeah, no, I agree with you. I think it's like those other books you mentioned are great places. If you're at like the beginning, or I think especially for like young people, 18, 21, maybe you're just coming out of high school or college, can really kind of get you thinking in a way that will really set you up for success in the long run. But this book, yeah, if you're like interested in the stock market, I think it's great. Definitely a little bit more like in the weeds, but it's still easy to understand. Like it's not like super advanced, but there are a lot of like really good principles in there, which we'll get to a lot today. That even rereading it like kind of refreshed different strategies that I could employ just in my investing style. So yeah, I think it's a great one to start off with. Like definitely, one of the first books I would recommend for anyone interested in the stock market. But I guess one of the big ideas that Mr. Burton Malkiel is all about. The book is really famous for the efficient market hypothesis. And I was wondering like where you stand on that, when it comes to just buying index funds and mutual funds versus individual stocks. Do you agree with the efficient market hypothesis, or do you think that, there's areas where it breaks down? How do you look at all that?
Yeah, I'll give my answer, but I'll give it with a caveat. And the caveat is this: that there is a distinction to be made between the um, the investments that you are betting your financial future on and the investments that you are playing with. And so for the investments that you're betting your financial future on, I'm an efficient market guy. You want it to be the most boring possible portfolio, owning as much of the marketplace as you can at the lowest possible cost in the most tax advantageous place. So that's the lion's share of the work that I do with the financial services clients that I work with, is just making sure that they've got the right dollars going into the right buckets at the right time in the right way. Now, if we're having fun, I might say bet on the things that you enjoy. If you drive a Tesla, buy a Tesla. If whatever it is. But like, I'm not going to recommend those things for my customers, and so it's a little bit of a different. Like, our purposes are different in that regard. And that's because I do believe that the market is largely efficient. I don't believe that there's anyone out there with any secret knowledge that is legal to hold, right? Anybody can trade insider trading, but that's illegal. And so I don't believe that there's anything out there. So if you want to gamble on those things, please, go gamble. Gambling is fun. But don't do it with the dollars that you're setting aside for your entire financial future. Does
Yeah.
that answer your question?
Yeah, no, I think you raised some great points, and it's funny. Like even the likes of like Ben Graham, Buffett, Peter Lynch had all basically agreed with the author's recommendation that for them, especially in the case of Graham and Buffett, it was a lot about value investing, which I don't want to say it totally doesn't work anymore, but it definitely is not like working the same way it did when these guys were really fully employing it 50 years ago, maybe even 25. Um, like the investing landscape has changed, and Ben Graham toward the end of his life was even on this EMH side, and Lynch and Buffett have both kind of said most investors are better off just picking index funds or just owning the whole market. And I think it's definitely true for most people if you have no interest in the market. But if you have any interest, or you're willing to do a little bit of extra work, I do think that there are caveats to it. And like my whole approach, like over time, I have kind of transitioned from primarily being in index funds to being mainly, for the most part, entirely in individual stocks right now. And you know, like the book talks a lot about diversification, and that's kind of what you were saying. So like I know that Burton mentions that like the idea of like beating the market is only possible to the extent that you're assuming greater risk. And I'd love to get your thoughts on that, because to me, the question that came to my head is, if I want to buy the best company or a handful of what I deem to be the best companies, is buying one great company really riskier than owning 10 companies that are so, just for the sake of diversity? What do you think of that?
Yeah, it's a great question. And the short answer is there's all manner of risks. So there is no one risk. And so a lot of what gets people confused is they use the term risk, but they're meaning two different kinds. So, for instance, there is company risk. If you diversify a portfolio, you are diversifying away company risk. Meaning, if you have 100% of your retirement in, I'm going to keep mentioning Tesla, right? You put it all in Tesla. Then you have 100% company risk on if Tesla goes bankrupt, you're screwed. And if Tesla blows it up, then you ride with them, right, so to speak. But that's perfect company risk that you are taking on. If you diversify, you spread that out. So that's when people talk about diversification, that's the kind of risk that they're typically referring to. But there's a number of different risks that are out there. So inflationary risk, sequence of returns risk. I mean, like there's any number of different risks that are out there. And so I just want to make sure we're not equivocating terms when we mean one specific thing. So to answer your question with respect to diversity, yes, the more stocks that you own, that company risk gets smaller and smaller and smaller. Now, what Burton refers to, where there is risk, there is return, that's actually referring to, like that phrase is actually referring to the power of capital markets. It's the way markets work, where if you're a risky company, the only way that you can get someone to give you their money is if you promise them a greater return compared to the next company down the road, which is more of a sure deal. And so that's just the way that capital markets work. It's the difference between debt and common stocks. So bonds are less risky than stocks simply by the way they work. And so, you have to be careful of the way that you talk about these things. It's not truly the interchangeable term. Does that make sense?
Yeah, no, it makes sense. Yeah, I think, and again, like for, a regular person who just has no interest in the market and really like keeping up with things, I think it makes sense. And that's where the index funds, like over long periods of time, historically, you can't go wrong. But I think the way I'm looking at it, like the maybe the risks like I'm talking about is, you look at the S&P 500 today, and really at the end of the day, like 6 companies, 6 or 7, the magnificent 6 or 7, however you want to look at it, really are the market, right? They're like 30% of the S&P. At the end of the day, like what happens to those companies is what's going to happen to the market. If they're up, market up. If they're down, market down. So you've got, let's call it around 70% that's now divvied out between the remaining 494 companies. So at the end of the day, like you really do have a very heavy concentration. And I think that the dynamic is changing a lot. Like, I'm not saying like, I think index funds are always going to be great, right? You always can get a good return. I mean, not every year, but over long periods, of course, 10 to 12% on average. But I just think that the world is changing quite a lot, and it's really just turning into like a winner take all market, where a lot of these legacy businesses that make up the S&P, if you look at like the S&P 500 this year, I think is up somewhere around 12 or 15%. But if you look at there's like an S&P equally weighted index. I think it's the RSP. Is the ticker, I believe. But instead of like weighting by market cap, it's weighted so that all 500 companies make up the same amount of the index. And that fund is down like a good amount. So I feel like, you could say like there's more risk in investing, if I only were to own the Amazon, the Teslas of the world. But I feel like I can make the argument that it's just changing so rapidly. The world is changing so fast. The pace of innovation is just the fastest it's ever happened, and it's just increasing. And I think you're kind of starting to see a lot of these old companies that like either haven't made the transition or just are way behind the curve are just getting left in the dust. And, these really what it comes down to is like big tech is just only going to grow and, really just continue to take market from a lot of the other players. And, we could obviously go into like specifics, but I think like, each of those companies is doing it. But Amazon is a great example of like these companies that have been around forever. Like Amazon is just slowly eating their lunch, right? And every year it grows and, it's taking from the others. And that's where I'm just like, sometimes I look at an Amazon and it's like I'd rather own just Amazon than own the entire S&P, at this point for a long-term investment. And that's just my personal, take, just because, I just think about Amazon. It's like, where's this going to be in 5 or 10 years, right? Of course, the government could break them up. Things could happen. But, usually even in a breakup, the business still flourishes very well because you really unlock like the segments that are actually growing fast. But, outside of that, I just don't see how they're not bigger, right? I think like Amazon is at, I believe, something like 3% of global retail penetrations, and similar for like what they do with the cloud with AWS. So there's a huge runway for growth. So I just look at something like that, and I think more so, in recent years, I've kind of started to invest, like, don't fight the trend, like I'd rather own that than, all these like dying legacy businesses that I don't know that they're going to be able to stay competitive. And I think you're starting to see changes that are starting to really happen, and it's going to happen faster than, a lot of companies are really prepared to like make that transition.
Yeah. So you raise a number of really, really good points that I do want to actually like lean into, because they're very good and they're very valid, but they're valid for reasons outside of the stocks themselves. And I think it's worth talking through that. So what you're seeing in the tech sector is essentially the capital market response to the technological singularity. Are you familiar with the technological singularity?
What's that?
Even if you were, I would still want to talk through it for anybody who's listening to the discussion. So I believe it was this guy Kurzweil who took, and again I think it's Moore's law. It's been a while since I've read into this, so I may get the names confused, but the principle is the same. He took Moore's law, which is that computing power doubles every year to 18 months, something like that. Well, that's an exponential growth curve. And so what Kurzweil did was he basically looked back at the history of technological innovation and plotted the exponential growth curve. And there was a pivot point where the computing power matched the processing power of the human brain. So as you're sliding up this curve, well, it's asymptotic, right? Suddenly the computers can build better computers than humans can. And then it's just, it's an upward curve from there. So as we're climbing up this technological singularity, the ability for tech to drive the market increases at the same pace. So it actually has nothing to do with the tech companies themselves. It has more to do with this technological singularity. And no other industry has the same growth rate. There's a guarantee there. There's nothing else that responds to Moore's law like the tech sector. So you mentioned Amazon. What is Amazon's business?
They are commerce, yeah.
It's absolutely everything. You could say that they started as a retailer, which is true, but now they own the real estate, which is digital, in AWS, right? They own the means of delivery, which is the UPS competitor, right? Like they own it all. And so if they are to be broken up by the government because they are a literal monopoly, by any definition of that word, I actually disagree with you that there would be similar growth. It's because they have that tech component that and they're able to outprice on anything. I mean, just like, yes, the runway is there, but without their tech component, I'm not convinced they would see the same kinds of returns as if they're truly a retailer like a Home Depot, right? Like Home Depot is not going to be able to compete in the same way. Now, one final thought on this. That's the external forces driving the tech market, which you're absolutely right to key in on. And I think we must acknowledge what tech companies are going to benefit from that growth curve. No one knows in advance. yeah, we can look back and say, look at NVIDIA. But nobody knew that that was coming. Or Mac computers happen to have technology. They weren't designed this way, but they happen to have technology that out of the gate ran AI very, very well. So when AI came out, if you wanted to run your own models, you really needed a Mac. That's not going to be the competitive edge moving forward as other companies are catching up. So nobody knows who is going to be the leader in this thing before it happens. It's always in retrospect that you see that. So that's my final thought. I'm curious to hear your take.
Yeah, no, that's you raise a bunch of valid points too, and yeah, Moore's law I am familiar with, but yeah, I think that when it comes to Amazon, at least, you know, yeah, I agree with you. Like they are a monopoly, but by like the traditional sense, they're not, and that's what they've maintained. And you look at it, like I can make the argument that Apple is more of a monopoly. Home Depot is more of a monopoly because these are businesses, Home Depot and Lowe's, like they each have like 40% probably of that market each of the home improvement. Apple has 50% of all the smartphone sales in the US. But Amazon, they don't have more than 5 or 10% of any market. But so I agree with you. It's like almost this new era of monopoly, like that maybe the laws are going to have to be revisited, but the way things currently stand, I feel like they can't break them up on the grounds of this is a monopoly. And it's also made more complicated because historically monopolies hurt the consumer, but Amazon continues to at least from their perspective and the words they use is that they keep making the consumer's life better, right? They're a deflationary force over time. They're making things cheaper. They're making it more accessible and convenient. So they're helping, right? And of course that could change, but by today's standards, like I know Lena Khan. They've been trying to get Amazon for a long time, and the best they can do is block them from buying a $1 billion robot vacuum company in Roomba, but they haven't been able to stick them because they have at the end of the day less, they're in all these different industries, retail, advertising, AWS, and yet at least with the retail side of things they only have maybe somewhere around 5% of the global retail market. So it's definitely tricky, and I think it's the first time ever that there's been something like this that is just at its roots a monopoly, and it's destroying so many other businesses, and yet it's making people's lives better, and it's very difficult to really prove that they're a monopoly, if that makes sense.
It does, and it is worth, here again is a term that can mean a bunch of different things. And so the traditional monopoly that you're referring to, that you can make the case about Apple or Home Depot, that's true in that they've gobbled up so much market share in their specific market. There's another term called a vertical monopoly, which if you were to look up, kind of the definition of that, that's the kind of monopoly that Amazon properly belongs in. And it still has those anti-competition aspects to it, where because of the income streams in the different sectors of its business, it's able to price out competitors in their broader market. So anyway, it's just, I think it's worth talking about, but not necessarily to go so deep on, because ultimately at the end of the day, what we're trying to get at is the ability for someone to pick a couple of key stocks and hang their financial futures on that. And my big thing is that nobody knows what is going to happen, and anyone who says that they do is lying to you. And the research continues to prove that story, that the best way is to diversify. And so I just wanted, since this book, I think this edition came out in 2015. The edition I originally read was several years before that. So it was interesting to kind of see some of their up-to-date stuff, which is now almost 10 years old anyway. Mm-hmm. But what I mean to say is that this research continues to be proven true. And so I'm going to share my screen with two pieces that came out recently from BlackRock and Franklin Templeton.
While
And
you
so,
do that,
yeah,
there was a quote on that topic in the book from Samuel Goldwyn, and he said, forecasts are difficult to make, particularly those about the future. So yeah, you're right in that it is just near impossible to, really pinpoint these things over the long run. You might be able to nail the trends and the momentum, in some regards, but there's just too many variables to really pick, how exactly it's going to play out long term. And I think that's a good. We could jump into some AI stuff after too. I think on that topic, but go ahead.
sure. Can you see my screen? Am I sharing that?
Here, yeah, I just have to press. Here you go.
Okay.
Okay, yep.
There we go. So this, first piece here is talking about diversification to essentially get away from that company risk. And again, it is because, to your point, that equal weighting, then you have 33% that are losing money that are dragging you down. And potentially the amount that they are losing is enough to offset the gains of the other 66% that are making money. I don't know exactly. I haven't looked into the one that you're referring to, but at the very least, over a period of 5 years, 33% of individual stocks lost money. Whereas if you had a diversified portfolio, it was really hard to lose money, really hard. But if you're out there trying to pick the right stock, it's not a coin flip, but even if you did make money, would you have made as much as a well-diversified portfolio? Who's to say, right? And so, yes, we would love to have those winners picked, but there's no way to know that we've actually got it until after the fact. And it's the same thing with timing the market. And this is another very well-known study. And it's just to say that if you miss the top 30 days in the market, the top 30 days, then you've basically got your initial investment's worth. It's the 30 best days in a given year that drive the majority of that year's gains. And so if you're trying to time the market, even if you own all the stocks that you could possibly own, if you're trying to buy and sell to capture those best days, if you happen to miss even 30, so it's less than 10%, those days are what drive the returns for the entire year. So, you miss 20 days, 10 days, or you just stayed invested is basically what this chart is doing. Now, if you miss 40 days, you might as well just have kept your money in cash, right? You lost money, and it gets worse the farther out you go. So this story has been time and again, demonstrated to be the case, and it's not changing. So, a lot of folks think that there's even predictive power in world events. And for those folks that are really concerned about, an upcoming election and the impact that might have, this is a chart that maps, I think it's like 40 or 50 years of the S&P 500 and how global events have impacted the market. And it's not even worth zooming in on the specific event, because what you can see is that it seems to have very little long-term effect. It goes up. That's what it does. So a lot of what I do when I'm meeting with my customers is trying to disabuse them of a lot of these notions. And I've only ever had one client who continued to think that he could go and find that investment manager who happened to know what the future was going to hold. I never tell my customers that I do. I'm trying to give you broad exposure to match that efficient frontier of risk and return. That's my goal, is to get you as close to the return that you deserve for the level of risk that you're willing to take. And I think that's really what Burton's trying to communicate, is pairing properly the risk to the return. What are your thoughts there?
Yeah, I think it makes a lot of sense. I mean, especially when it comes to trading in and out of the market. I mean, it's impossible to time. I do think that the odds are more in your favor, like the longer you go, like I think there's a few reasons for this, but like maybe we'll have to do a little study. I mean, it's tough because it would have to span for years, because I do think I could select a handful of stocks that outperform the market, say over a 5-year, 10-year period. I think it's easier to do today than it was 20 years plus ago, just because it's easier to get, a lot better information. The playing field is more level. You can kind of crowdsource ideas, like talking to people within industry. And like, I think that, it's possible to do for most people. Yeah, they're better off with just index funds. But when it comes to short term, yeah, trying to like time it around events and stuff like that, you're going to get crushed. And personally, yeah, anytime I've tried to predict, earlier on in my investing career, it's like, oh, this is going to happen, so gotta get out of this. You can be right, and the stock market still goes the other way, because there's too many variables. And like, I know for a long time, basically since 2022, everyone has been talking about how like I don't know if you're familiar with like the yield curve inversion.
Mhm.
So, that's supposed to be the indicator. Oh, every time this happens, we get this terrible recession, and it hasn't happened, So it's history rhymes, I guess. It doesn't completely repeat identically, but I do still think that like I think that, I definitely agree with what you're saying. And like when it comes to like timing the market, it's just folly. But I think that you can, with a, carefully selected and curated list of stocks over a long period, you can outperform the market if you just have any semblance or interest and willing to do a little research, and like kind of can just what the great companies are. I could get deep into it. Maybe we'll have to do another episode on this, but you can kind of see where things are going. And I'm not talking about like AI, which we definitely should get to, because I think there's a lot of relevant stuff in the book on investing in these the hot new thing. But when it just comes to like the Amazon example, things like that, and I'm not saying like go all in on it, but if I could own 10 companies like that, spread out amongst different market or sectors, however you want to look at it, I think you can beat the market. And that's kind of what I've done since 2019, just with like my personal individual stock picking. So yeah, that I definitely agree with, a lot of what you said, but I also like see what I've been able to do.
So it's tricky, and I think it would even be worth another conversation to go into. And the reason that I say it's tricky is because you can't say that you've beaten the market unless you have a relevant benchmark. And it's very, very difficult to come up with a relevant benchmark. It's actually, and this is in the industry, peeking behind the curtain of financial services. On the investment side of the house, there's insurance as well. And there's a couple things in the book I didn't want to actually maybe critique him on. But in the investment side of the world, for folks that work professionally in financial services, the great way that I see manipulation is by picking an irrelevant benchmark to compare your own results against that deceptively communicates to the customer that the financial services professional has done better than they actually did. So everyone is subject is the word I want, subject to this temptation. And it's something that I would want consumers to be aware of. If anybody's ever trying to sell you on their performance, on the investment management side of things, challenge them on their benchmark. So that's my buyer behavior speech.
And I think the other thing too is like past results are non-indicative of future, right? I mean, right. Just because I've done well the last 5 years doesn't mean anything for the next 5. And I think the perfect benchmark for that is, I don't know if you're familiar with the company ARK Invest.
I've heard the name.
Have you heard of them?
Yeah.
So they had a really good run for like 5 years where they were up hundreds of percent while the market was up, 60 or 100, maybe a little less. So far beating the market. And then, people think that's just going to continue forever. And I actually invested in ARK a long time ago too. and lost my shirt because the next few years didn't go like that. And yeah, especially when it comes to like these big funds that have to, they can't like hold cash. They have to be buying and selling stocks constantly. They're essentially doing what you said earlier is a no of like trading in and out, and you just get destroyed over time. So that's what I would say on that. Yeah. What is like an example of, what would you say is like a bad benchmark, and what's the best benchmark to use? Because I just kind of look at like, did I outperform the market? But I also recognize there's going to be years where I don't beat the market, and I don't live and die by, okay, my year to date returns versus the market, because like I said, like I think I'm investing in things that over the long term, like 5, 10 years, that's where it's really going to shine. Year to year, I'm not like super concerned, but it's just a benchmark of like, am I wasting my time? Like, should I just be buying the index? And so far in my journey, that hasn't been the case. So what would you say about that?
Yeah. So let's talk about a couple temptations that you might run afoul of in trying to find a relevant benchmark. So one temptation might be to use the 60-40 portfolio, 60% equities, 40% bonds. And of course, the question is which equities and which bonds. But if you're just comparing it against, the industry best practice, so to speak, what many charitable trusts are using as the prudent investor portfolio, that's going to generate, at least it has, again, no guarantee of the future, but what they refer to as the expected rate of return for that portfolio, let's say, is 7%. So that might be your temptation. Has my portfolio, for as long as I've been working with it, done better than 7%? And that's the long-term expected rate of return, which is, in our investing world, long-term is 10 years. So, you've got at least 10 years, you've done 7% average rate of return, that might be your temptation. Well, if your portfolio is 100% in stocks, that's not a fair benchmark. You're benchmarking against a portfolio that has, by definition, 40% bonds, which are more conservative, and the expected rate of return on just those bonds is much lower. Right? You're blending in the bonds to remove volatility, which is the goal of that blended portfolio. So that's not a relevant benchmark. So then, what if your portfolio is 100% stocks? What about 100% stock portfolio? Well, there's no equivalency just because you have 100% stocks. You could choose those stocks by market capitalization. You could choose those stocks by sector. There's any different number of ways to, sort of build that portfolio. And how do you know that you have, a one-to-one? So are you comparing Apple to Microsoft? Is that your benchmark? Like, why would that be relevant? So does that make sense? It becomes very, very difficult. Yeah.
Yeah, no, that makes sense. Yeah, I generally like am just investing in stocks, so like I'll just look at the the S&P or the total market. But I also, like I said, like I think people get way too caught up on short-term performance, and that's all where you also lose out, because you look at what's happening right now. Like Nvidia had a great run, but I think it's topping out here. And I would not short it or anything, because these things can just go on. Like we said, you really can't predict the future. But I would feel comfortable, like for the rest of the year or the next couple here. Tesla has really been terrible stock performance wise, but I think like Nvidia is kind of topping, and Tesla might just be getting started again here. So I just look at things like that, and these are multi-year cycles, because a lot of these industries are cyclical. So I kind of look at it like all that, like maybe the 3-5 year benchmark versus the market. Again, at least just for what I'm trying to do, it's like, is it worth? Am I putting in all this time and getting that much higher of a percentage return, or would I be better off just going the index route and the 60-40 type portfolio? So that's kind of just been how I've looked at it.
Now, this gets back to, my original caveat that what I'm referring to and what I do for folks is their portfolio set aside for their financial goals. I think that there's a lot of value and a lot of fun in doing exactly what you're referring to. And so if you want your benchmark to be yourself, I think that's actually a really great way to do it. So you have these two portfolios. One is as boring as you can possibly make it, doing the 60-40. And then the other is your play money. And you're seeing if over time you can get a better result. That's a great way to do it, because in both scenarios you win. Right? Mm-hmm. You're making yourself be the winner. And even if on the portfolio that you're picking the stock, you lose every dime, well, you had fun doing it and you didn't bet your financial future on it. So it was just pure entertainment, as opposed to, now you can't feed your kids, right? Like that's the tragic scenario that I wouldn't want for anyone.
Right. Definitely. So I think, this is an idea that I've kind of heard a lot. He kind of touches on in the book, but I know Peter Lynch was a big proponent of kind of avoiding the hottest industry or the hottest stock in the hottest industry. And, in the book, like Burton kind of outlines a similar thought process, just in that I think this is super relevant to what we're seeing with AI right now, that investments in transforming technologies have often proved unrewarding for investors. And there was a quote in there: the key to investing is not how much an industry will affect society or even how much it will grow, but rather its ability to make and sustain profits. And history tells us that eventually all excessively exuberant markets succumb to the laws of gravity. I think you're seeing that play out right now with AI, because I think there's definitely a lot of benefits, and long term it can be very transformative, and there will be some companies that, do very well. I think similar to, the internet cycle, right? But the ones at the beginning, like you kind of alluded to earlier, it's impossible to predict today, like who's going to capture the lion's share of that. And I also think it's going to play out a lot slower than people think. Like, ChatGPT is a great tool, but you're already kind of seeing the usage drop off, right? Kids are out of school. It's summertime. They don't need to cheat on their papers. Nobody's using it anymore. So, things like that are useful. And I know like there is a lot of usefulness on the business side, just kind of increased efficiency and productivity, making things that used to take hours or days, can be done in 10 minutes by the AI. But I think it's limited in scope, and you're kind of already starting to see the sentiment is changing in how the media is talking about AI. And, I think the number is something like, these big companies that bought, made all these investments into AI have spent somewhere in the ballpark of $60 billion. And the revenue they've been able to show a result is around $3 billion. So like, that's not a sustainable trajectory. So yeah. I think that it's just another great example of, this transformative technology may not translate into results and returns.
Yeah, I agree. I definitely agree. And I was trying to think, it reminds me, so in the book, Burton goes through several great historical booms and busts. And it was fun to go back and read, because I had forgotten that the first time I ever heard about the tulip bulb bubble in the Netherlands was from this book. And so I went back and reading, I was like, oh yeah, this is where I learned about that from. And so anybody who's unfamiliar with that, it's a good cautionary tale. And so, you kind of have your tulip bulb in the sudden release of AI into the wild. Now, that being said, I do think that this new technology will find its way in a very productive manner into every level of business and life. And even though we're not there yet, it's coming. And when I talked about the technological singularity, this is actually an area where I kind of want to smack around economists. because economists have a term, I'm going to forget off the top of my head. It's something like costless reallocation of resources. It's something like that. But when there's a dramatic shift in an industry, the jobs that are lost because of that dramatic shift end up costlessly reallocating to another industry. So essentially, like, I get fired from my job because of this new thing, so I go and find another job. And they call it a costless reallocation because there's a net zero loss to the global economy as a result of that. I just go and find another job. What they're essentially doing the same mistake that people in the investment world, past performance does not guarantee future results. There has never been the same kind of technological advance in any industry that we've ever experienced as we are experiencing now. Technology will continue to change at a quicker and quicker pace, and it's because of Moore's law. So if tech is changing at this rapid pace, it stands to reason that the number of jobs lost as a result of these changing technologies will only increase at a quicker pace than they can be replaced. Your point is well taken that so far it doesn't seem to have had that effect, but it will.
Right.
And those jobs that get lost, I think there's actually going to be a lot of pain for the average person. But here's the thing. I don't think it will translate to a loss of value for the companies that are making use of that technology. So you have a difference in the capital market versus the average Joe who's employed by X company. Does that make sense?
Yeah, and I think are you familiar with Gartner's hype cycle?
No.
So I think this is the perfect way to put a visual on what I was describing. I definitely agree with what you're saying, but I think what I meant was more, so this is Gartner's hype cycle. You have the new technology, you get to the point where, expectations have gone through the moon, to the moon, and it just, you have this period of irrational exuberance, which I think that's kind of what we've been having. And I think when you look at AI, we're right here right now. I think you're at the top of this hype and expectations, and I just think it's going to take longer. I agree with you, the long-term trajectory, everything you said, that's all going to happen, but short term, maybe the next, who knows, 6 months, 3 years, somewhere in between, we're going to go down, and you're going to get all the way down to this period of disillusionment, and then the AI will kind of gradually go up at the pace it should have. But people just, tulip bulb craze you brought up, we could definitely get to that. And then it's more of a sustainable, slow path up, and then it kind of levels out eventually. So I think this is what you're going to see about to play out with AI. And again, it's funny, like if you just compare kind of sentiment and like how the media has been talking about it, it matches with every cycle where like it's over the top, right? And then we get to the top here, and all of a sudden the tone is changing, and they're saying, oh, maybe this isn't going to be what we thought, or there's all these problems. And like I said, I think NVIDIA in the last week, I have to check, I'm not sure today. Well, we're filming this on June 28. NVIDIA is down like 10% from its peak relatively quickly. So I feel like we're kind of potentially topping out when it comes to AI for the short term. And I think it's just gonna go through an ugly period, but then eventually it will, have that slow and steady climb upward with like the valuations that make sense, with more realistic, expectations maybe for the short term.
Yeah, I mean, what was this called again? Who is this?
So this is Gartner's hype cycle.
Okay. Yeah, I mean, if you look back at the .com bubble, for instance, the internet didn't go anywhere. We still have it, and now every business has a storefront with a www. whatever. And it doesn't change the fact that the .com bubble happened. Mm-hmm. So yeah, I mean, you're definitely seeing proof of that. Same with the real estate bubble. in 2008. Like, everybody lives somewhere. So yeah, that's fascinating.
Yeah. Yep. And I think it is in a lot of ways the latest tulip bulb craze. Like, it was really interesting. Like, Malkiel goes into all these tulip bulb, crazes that amount to like get rich quick, and they obviously never work out. So yeah, I just kept thinking about like where we're currently at in the cycle, and like that's kind of my thesis of like where we're headed here. Um, I think I had like a couple other little things here that I thought were interesting.
Sure.
He talks about analysts, like when they say buy, they really mean hold, and when they say hold, it's a euphemism for dump this junk as soon as possible, because because you look at the industry, CNBC, the analysts, there's always a bias to give buy advice, because skeptics don't last or make money for the industry, right? And they treat it like the Super Bowl, like it's this play by play, when investing really is this long term thing where like the day to day doesn't matter. There's just so much noise that's irrelevant, and kind of also ties into like there's been an egregiously poor track record for like professional fund managers to move money from equities to cash and vice versa, based on the forecasts and the economic conditions. Goes back to what you mentioned earlier. You missed those 30 days, you've missed the best returns, and how the peaks in, these mutual fund cash positions have generally coincided with the market bottoms, and then vice versa. They have their cash positions invariably low when the market is at its highs. So very hard to predict the future.
Well, if anything, it's an encouragement that these professional money managers are the same people affected by the same emotions that the retail investor is. Because what you just described, and I've seen the chart numerous times, when the headlines are screaming buy, 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 is usually at the peak of the market. And then when they're screaming sell, 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 it's usually at the bottom of the market. And so if you're buying high and selling low, that's a really great recipe for losing money, as it turns out. And so, just tuning out that jump, because they're not in the business of advice. They actually can't legally do what they do and call it advice. They have to call it education, but ultimately they're just there to sell ad space.
So they're entertainers.
They're entertainers. That's exactly right. And so you need to hold these things as pure entertainment and nothing else. And as a matter of fact, I was trying to remember as you were talking about this, because it's so consistently true that there's one well-known talking head. He rings a bell and he's corn.
Lightning round.
Yeah, right. And there was a study.
Bye.
If you just did the exact opposite of what he told you to do, you would have made money. As opposed to doing what he told you to do, you would have lost money.
I think there's actually this individual, I'm not sure if it was officially made, but I know there's like trackers out there that actually have like an inverse fund of doing exactly that. You just do the opposite and you do better.
And so maybe that's what you go with. I don't know. Maybe that's the way to make money. But yeah.
Cool. Well, I can't believe we've been going almost an hour here. It doesn't feel like it. This is fun. Did you have anything else from the book or anything you wanted to discuss?
I mean, so yes, and maybe we can schedule another time to go through it. But just to say that I mentioned in the industry, so I've worked in actually every context that you can, working with retail investors. So investments, insurance, both, as well as the paid financial planning component. So I've done it all. And what's been fascinating for me to see is that folks that just do insurance tend to have insurance-only solutions. Folks that just do investments tend to have just investment solutions. And folks that do fee-based planning tend to have solutions that involve some sort of fee that they can charge. And so, Burton's content here, he's clearly an investment guy, so his expertise and recommendations tend to skew to the investment side. Because I have such a global perspective, I actually have a number of things that I push back on just to bring clarity. My YouTube channel tends to focus on the proper use of life insurance, in part because of my compliance requirements. I can't throw investment recommendations out there. I would love to be able to. I can't do it. Just because, again, there's just as bad information on the investment side as there is on the insurance. So, I'm a little bit limited in what I can talk about outside of a one-on-one conversation. But if you wanted to talk a little bit about that, we can. We're probably out of time for this talk.
Yeah, I mean, we can keep going if you want, or like you said, I think we're gonna have to do more of these. This was fun. A lot more fun talking to someone than me talking to the screen.
Yeah, definitely. Well, cool. I mean, and you can always, I guess, cut and then launch into another topic if you wanted.
Sure. Yeah. Yeah. I think that's probably a good place to wrap it up for today. We'll definitely have to do more. Everyone, let us know in the comments below if you enjoyed this kind of content. Definitely have to get Mike back on here. And where can people find you? You mentioned a YouTube channel.
Yeah, it's again very limited, and it was just because I had a number of conversations around life insurance that I just kept having over and over, and so I put that out there. I actually had another today that I need to film a video of because it's relevant. But you can just find me at Tolliver Agency. That's my handle, and so that content is out there. And yeah, if you want to learn a little bit more about life insurance, you can check me out there. Or if you were interested in, implementing many of the things that Vinny talks about, I'm happy to help folks do that. I have all the licenses and have been in the industry for 11 years. So.
Awesome. Yeah, I'll definitely link that in the description below. You guys can check out Mike. Well, thanks again for coming on. This is fun. I think we'll have to do a little book club or explore some more topics for sure in the future here. Yeah.